Classification of financial liabilities is relatively simpler. There's no business model test and there's no cash flow characteristic test. If a financial liability is a non-derivative liability, it shall be classified as amortized cost. And if a financial liability is a derivative liability, it shall be classified as fair value through profit or loss. In addition, there is an option to designate a financial liability at fair value through profit or loss in any of the following cases. If doing so reduces or significantly reduces the accounting mismatch, we discussed this when we were discussing the classification of financial assets, or if that liability is part of a group of liabilities or a group of assets and liabilities which, first of all, is managed and its fair value is evaluated on fair value basis in accordance with the documented risk management strategy, and information about that group is provided to the key management personnel on fair value basis. Finally, there are some special liabilities with specific treatments. Liability pertaining to contingent consideration recognized by the acquirer in a business combination shall be measured at fair value with changes recognized in the P&L. Financial guarantee contracts and commitments to provide loans at below market interest rates shall be subsequently measured at higher of the amount of loss allowance determined in accordance with IFRS 9 impairment requirements, or the amount initially recognized less the cumulative income recognized under IFRS 15. Lastly, as we learned before, there are financial liabilities which arise because the transfer of a financial asset does not qualify for derecognition, and therefore we have a financial asset and financial liability that arise because of that, because we have a right to receive from a party and obligation to pay to another party, as we discussed in the previous videos, and so the financial liability arises. In that case, that financial asset and the resulting financial liability shall be measured on net basis, such that if the transferred asset is measured at cost basis, then the net carrying amount would be amortized cost of rights and obligation retained. Or if the transferred asset is measured at fair value basis, then the net carrying amount would be the fair value of rights and obligation retained. In the next video, we will be learning about the impairment of financial instruments, or more commonly called as expected credit losses model under IFRS 9.